Welcome, Hugh.
Hey,
We're
hey,
now live and waiting for Brave to join us. Welcome, Brave. Can you hear us? Let's wait one more minute as Brave solves his technical issues. We will start soon. Thanks for joining us. Thanks everybody for tuning in. We are solving some technical issues on our end. This is the first time we are using a restreaming tool. So please bear with us. We will start in the next minute or so. Thank you.
hear me? Yes,
Hey Brave, let's check if things are working this time. Can you hear me?
I can hear you. Can you hear me? I can. I can hear you both. Okay. So, Hugh, you can hear me.
I can hear you now. Sorry. I think this was a problem on my end. Again, apologies for the brief delay. I think we are ready to get started. Hi, everyone, and welcome to this week's DeFi Pulse. This is our first time restreaming the call across our main social channels, including LinkedIn, YouTube, and X. We host these calls regularly to bring our community together, share key updates, and provide insights into the evolving DeFi landscape. Brave New DeFi, who leads product and risk at Nexus Mutual DAO, curates a comprehensive report on DeFi market trends, risk events, and yield opportunities. If you are tuning in for the first time, you are in for a treat. This report offers a high level comparison of DeFi and TradFi, making it one of the best ways to stay informed on yields, risk, and the macro trends. Hugh, our founder, will share updates on Nexus Mutual's strategic priorities with a focus on growth. Since the launch of Nexus Mutual V2 in March 2023, The ecosystem has expanded significantly. Last year, member rewards were largely driven by new product launches in collaboration with our partners, and this was an important milestone in our journey. Hugh will walk us through the latest achievements and will touch upon what is next. Last but not least, on the community side, I will share updates on engagement and contribution opportunities for our members and for DeFi enthusiasts. Over the past year, we have prioritized fostering learning and collaboration on key topics like DeFi, risk, and progressive decentralization. Today, I will highlight the DeFi and Risk Learning Group, which will be our first cohort based program, and we'll touch upon its application deadline along with a quick recap of last month's sales performance. With that, we're ready to get started. Brave, over to you. What is happening in DeFi?
Thanks, Sam. Good morning, everybody. I'm Brave New DeFi, and I'm head of product and risk at Nexus Mutual. Before I jump in, I just wanted to say hello to everybody that's listening in on X, YouTube, and LinkedIn. Looking at the market overview, broadly speaking, the market is markedly different than when we last held our DeFi Pulse call. Over the last month, Bitcoin's price has fallen by 16%, and ETH's price is down 29% over the last month. That large drop in the market is largely due to uncertainty around U.S. policy as the Trump administration pushes forward with tariffs that's slated for April 2nd. In the past, the administration has pushed back that deadline, but it's uncertain if they're going to do so again once that April deadline approaches. And there's broader worry in the market about an aggressive shift in U.S. policy that could lead to a recession, with JP Morgan updating the prediction rate for a potential recession from 30% to 40%. There's also some prediction markets live on Polymarket asking users if they think a U.S. recession is going to occur in 2025, and it looks like 39% of users are voting yes. So because crypto markets are risk on, they tend to feel the greatest amount of pain in wider market sell-offs. I've always found the performance of tech stocks is closely correlated with the performance of crypto markets, with the notable exception that volatility in crypto markets is far greater than you'll see in tech stocks. At the start of the year, many folks were happy to welcome crypto into a new golden age, but for now, the shine seems to be gone from the market, and the appetite for leverage, which is a major driver for on-chain yields, is significantly less than it was 3 to 6 months ago. Looking at crypto funding rates, those reflect the drop in sentiment among traders, with many on-chain and off-chain markets showing negative funding rates, where those shorting major blue-chip crypto assets are paying those with long positions. In a bullish market, we'd see longs paying shorts. But based on yesterday's data, the average ETH funding rate was around 0.33% per year, with rates trending negative as of this morning, or the average rates trending negative as of this morning. If we look at the benchmark rates on Vault's FYI, I use those rates they aggregate on their site. We can see a similar drop in on-chain yields over the last month. Benchmark USD rates are at 3.58%, down from 8% a month ago. Those are based off of the yields available on the largest on-chain lending markets. And benchmark ETH rates remain flat. They're pretty consistently around the same at 3.04%. That's the average yield among ETH liquid staking tokens and liquid restaking tokens, or just ETH that's staked securing the network. In the past, I've noted that when on-chain yields rise above U.S. Treasury yields, we see more capital come on-chain. And as of last week, on-chain benchmark rates have fallen below U.S. Treasury yields and the secured overnight financing rate. However, we have hit an all-time high for stablecoins recently, which means there are more people holding stablecoins on-chain than ever before. If on-chain yields and the broader crypto markets continue to slide during a wider macro downtrend, we might see the stablecoin market cap drop as funds flow back into traditional markets. But for now, it seems like people are just holding in place on-chain and stablecoins. Market sentiment might be bad, but there's still some standout on-chain yields for stablecoins. Looking at some of the fixed-rate markets on Spectre Finance, there's been a pretty wide source of yields on Spectre Finance for stablecoins and other assets. But there are a couple markets on there that are paying between 10 to 16%. So the Resolve wrapped staked USR market, which is a delta neutral strategy, The fixed yield there is 11.56% with maturity on June 25th. And then for those who are in the Yearn market for Go and USR, if you are providing liquidity for those two through Yearn in a curve market, you can put your LP token on Spectra and earn a fixed yield of 15.25%, with that maturing on August 6th. Looking over at EtherFi, EtherFi's liquid market neutral USD vaults currently offers 12.2% APY with EtherFi loyalty points and Athena Sats points in addition to base yield. Those points get converted to tokens at some point, which provides some additional yield. Looking at some other options that are maybe not as complex, Inverse Finance's Stake DOLA currently offers 8.2% APY. Stake DOLA, DOLA is a stable coin, and Stake DOLA is earning yield from revenue generated in the inverse firm lending markets. So revenue generated paid by lenders gets put into the Stake DOLA contract, and those who hold S DOLA or Stake DOLA are earning that yield. The Stakehouse Financial Smokehouse DAI Morpho Vault currently offers 8.28% APY. Most of the underlying markets here are exposed to staked USDE or USDE, which is Athena's internet dollar, or the USDE, SUSDE Pendle positions, where users are earning a fixed yield in Pendle markets. Yields on Pendle are currently higher, and demand for leverage has been higher because people have been leveraging up on those positions, which is what's leading the higher APY in that Stakehouse Financial market. Looking at Fluid, which is Instadapp's lending protocol, they've offered higher yields above the benchmark rate over the last week, with rates for lending USDT and USDC in the arbitrum markets between 7 and 8% APY. And last but not least, the Sky savings rate, which currently sits at 6.50% APY for SUSDS holders. The Sky savings rate is now on Base and Arbitrum in addition to Ethereum, which is helping grow USDS adoption on L2s. If you're not familiar with Sky Protocol is a lending protocol that's been around since 2017, 2018, formerly known as MakerDAO. And the Sky savings rate is a vault that earns yield from US Treasuries that MakerDAO holds off-chain. That yield flows in and generates yield for those who stake their USDS stablecoins in that contract. That's generally the base rate in DeFi. That's kind of what drives different yields in lending markets, but right now that is higher than we're seeing the benchmark rates. So that may be adjusted, but for right now, it's earning 6.50%. So there are still attractive yields on stablecoins that exist on chain. They're just not as common as they were several months ago. Looking over at ETH yields, ETH-based yields tend to range between the base staking rate of 3% up to 8% in certain markets. However, most higher yield opportunities trend around 5%, which provides a 2% premium on the ETH staking rate. There are some exceptions, though. Looking at EtherFi's liquid ETH vault, users can earn 9.2% APY plus EtherFi loyalty points and King points. Again, these convert to tokens at some point in the future, which provides some additional APY. STETH on Instadapp has been earning 7.97% APY annualized over the last week. And in some Euler Finance V2 markets, ETH is earning between 5% and up to 13% based on demand for leverage in those markets. I'll keep an eye on the wider yield environment and share updates in our next call. I think the direction of the market is going to dictate where we see yields go. But for now, there are still some good opportunities on chain. And of course, everything I've talked about today are things that we cover here at Nexus Mutual against smart contract risk. Looking at the risk landscape in DeFi, there's been a lot of discussion about this. I'm going to let Hugh talk more broadly about the Bybit hack and centralized exchange exposure, but I wanted to provide a broader picture of where on-chain risk is trending. So in 2024, there was 2.2 billion lost to hacks, according to Chainalysis, and 43% of those losses were caused by a private key compromise. This is something that we've talked about before. Private key compromise is something that's kind of hard to cover from a risk perspective because it's very hard to determine whether or not fraud has occurred. But we are seeing some commonalities and some common attack vectors, specifically by North Korean state-sponsored actors like Lazarus, who are targeting some DeFi protocols. We've noted with Bybit and with other hacks that have happened in the past that these actors have been able to compromise enough signers that are using safe multisigs. So there are multiple points of failure due to malware. And then because those safe multisigs own a proxy contract, and for those of you who aren't familiar with what a proxy contract is, within a protocol, which is just a set of smart contracts, there are some contracts that are able to upgrade or control other contracts. And there's a benefit of using those from a security standpoint. If there is an issue, you can mitigate it by upgrading the contracts using that proxy contract. The flip side of that is if somebody is able to access the multi-sig or whatever address is securing that proxy, then they're able to upgrade those contracts to a potentially malicious contract. This is what we saw with the Radiant Capital exploit that occurred in 2024, where they were able to compromise the signers, take over the proxy contract, and upgrade the lending markets, so they were able to take all of the funds out of those lending markets. So private key compromise made up 43% of the losses in 2024. That trend carried over from 2023. So it's been something that we've been looking at on Nexus on how we can cover this risk specifically. It's something I've been talking about with Hugh in great detail. I think we're making progress on some potential products here, but this is one risk that people are very concerned about. Smart contract risk is still present. We're still seeing losses due to smart contract hacks. There was about 1.4 billion in losses due to smart contract hacks in 2024. So far in January and February, we've seen somewhere in the realm of 130 million in losses due to smart contract hacks, but they've been more spread out. We've seen larger impacts due to centralized exchange hacks here so far in 2025. Broadly speaking, though, smart contract hacks are a little bit more nuanced, and like I've said, private key compromise has been a leading attack vector, and it's something that people are very worried about. There's different tools out there for individuals who are worried about having their wallets compromised, but for developers who are working with, enterprise-grade solutions, there's more that can be done, and there's been a big discussion around this, especially given the safe Bybit hack, which I'll let you talk about a little bit more. The other thing I wanted to note is with the rise of things like Athena's USDE and SUSDE, that exposure on lending markets, things like USR, which also have off-chain exposure, more of these real-world assets that are getting exposure through Morpho markets or on Aave or other major lending protocols, with more off-chain risk being brought on-chain into these lending markets. There are some compromises being made in terms of how the price of those assets is being sourced. Aave is passing a proposal that would hard code the price of USDE on Aave to USDT. So if there's market volatility, users aren't liquidated because there's short-term volatility within the market. Within Morpho, you're seeing some of these things for USR and USDE and some other assets that have off-chain exposure. They're using hard-coded oracles where the price is hard-coded to $1. Some instances of that. So the issue with a lending protocol, one of the benefits is when the oracle, which is the source of truth for the price, shows that the price is dropping, you can be liquidated and all of this is automated. If you're using a hard-coded price oracle, though, and it's hard-coded to $1 and the price of that asset drops, but it's not reflected by the oracle, you're not going to see liquidations occur. So it gives a benefit to borrowers and it adds more risk onto lenders. I've talked about this before. I think there should be risk premiums in some of these markets. It's not as widely recognized in front ends. So as a user, when you're coming in to lend, you're not fully aware that you're exposed to these risks. I'd love to see that trend change. That's something that we do cover within Nexus with severe oracle failure and manipulation, and also covering against losses due to bad debt for lenders. So it's something that we do cover, and it's something that I monitor quite closely. But it's definitely one trend, especially with this downturn of the market, that I think users should be aware of and be prescient of when they're deploying funds in DeFi. With more of that happening, especially with what happened with the Bybit hack, Athena has some of their funds on Bybit. If if funds get locked up on an exchange, they use a copper wallet, which segregates custody out. So the funds aren't actually held on the exchange. But if Bybit went into bankruptcy, those funds would still be frozen in that copper wallet as part of the bankruptcy process. And then you would have a shortfall with the exposure that's backing the USDE token. It's unclear what legal rights token holders have, so this would essentially cause a DPEG. We offer DPEG coverage as well, but this is something broadly speaking around lending markets that can cause some contagion risk. So just be wary when you're lending out there in DeFi and looking at some of these risks. We offer cover for some of these solutions, but this is a trend I'm keeping a close eye on, and I think this is something that's more than smart contract risk that users should be aware of in the market. But on this note, I'm going to pass things over to Hugh to give his foundation update, and he can give you a little bit more information about the Bybit hack. Hugh?
Cool, thanks, Brave, and hey everyone. Good to be here on the new platform, and welcome to anyone who's joining in for the first time. My name's Hugh Karp. I'm the founder of Nexus, insurance professional by background. Been doing the insurance thing for a while. I'm an actuary by training, so life insurance by background. So yeah, thanks, Brave, for pulling all that together on the risk report. I think one thing, just very briefly, is even if you don't understand all of those projects and terms and all the rest of it, I think one thing that's really fascinating with DeFi is the fact that people like us and Brave can dive into the details, because everything's fully transparent and you can actually get to the details and discuss this stuff in an open way. That's a massive difference from TradFi, where it's just a bit of a black box and you can't really understand exactly what's going on. But all of those things like hard-coded oracles and yield opportunities and all of this type of stuff, it's all fully transparent, so you can get into those details and really understand what the exposures are if you've got the time. Yeah, so I guess a few things from my side. I'll go through. I wanted to kind of give a bit of an overview on what we've been doing on the project, on the foundation side, in terms of the project team and what's happening, and then give you a bit of an overview of the Bybit hack that happened a few weeks back. Give you a bit of an insight into what actually happened there and where the risks actually are. But yeah, a few things from the team side first. Our investment committee has started producing regular book value reports in a nice waterfall attribution analysis diagram, which I really love, because it kind of gives a very quick insight into how the mutual, where the funds are coming from, where the value's coming from. So check that out. It's kind of all information is fully transparent, but it's always nice to have a nice graph to point out once a month. So have a look at those. It shows you where the surplus is being generated from. The other big update is the BitTensor BitAgent cover. So, excuse me, BitAgent is basically they run validators on the BitTensor protocol, and there are risks. You basically can stake the native BitTensor token, which is Tau. You can delegate that to BitAgent, and BitAgent then stake that and earn a yield, performing some validation services in return for that yield. And that yield is spread amongst the people who delegate. And BitAgent have bought cover on for all of the people that delegate to them through Nexus and Native, which are an insurance broker that we work with quite closely. And so that's a kind of first of its kind one. Firstly, first slashing risk coverage on the BitTensor protocol. Secondly, one of the first ones that where a provider is providing coverage for all of the people that delegate to them. So it's a pretty big deal. 25 million of coverage, which is pretty big in terms of the crypto risks market as well. The Bybit hack. So yeah, I thought I'd just give you a little bit of insight into what happened here. At the end of the day, Bybit lost about 1.4 billion, and I think they got some of the funds back, but not very much at all. So this was a big impact. So Bybit are a centralized exchange. To give you an overview of what happened, generally what happens here is that centralized exchanges generally split their funds held between what are called hot and cold wallets. Hot wallets tend to have smaller amounts of funds. They're kind of like working capital for the in and the outflows. And generally the keys are stored on servers to allow basically automatic processing of how the funds go in and out. And so they hold at a smaller amount. They're generally, security controls are obviously still very high, but they're lower because they're on servers, etc. Cold wallets are offline storage. Usually there's basically multiple signers, whether that's either via an on-chain multi-sig wallet, or whether it's like MPC, which is multi-party computation, so like off-chain multi-sig that controls one key. And so the way Bybit was set up was where they were using the safe multi-sig, on-chain multi-sig. And so what actually happened here? Well, Bybit was scheduling to perform like just regular operation. They were going to transfer funds from one cold wallet to another cold wallet. And so what they do is they go into the safe UI, which is basically the wallet user interface, and they set up the transaction. And at this point, everything seems fine. And the signers go through their signing process and confirm on their individual hardware wallets. And what has happened here is that the UI is showing everything is as it should be, but instead, what has happened is the user interface has sent a malicious transaction to the signers to actually sign, and they sign it, assuming what they're signing on their hardware wallets is what it shows on their screens. And so that wasn't the case, and that malicious transaction transferred ownership of the entire multi-sig wallet to the hacker, and they basically drained the funds. So what actually went wrong here? There's a couple of things, but the first thing was that the safe UI was compromised. So the Bybit themselves weren't compromised at all, or none of their signers were actually compromised. They were just tricked into signing a malicious transaction. And the way that they were tricked was that the user interface they were using, which is a third-party user interface, Safe, they were breached, and so the hacker had breached Safe's systems. They'd uploaded malicious UI, which basically just targeted Bybit, and they just targeted Bybit because Bybit had a lot of funds. They could have targeted a whole bunch of people, but they just targeted Bybit. And they basically tricked, instead of showing the normal transaction, they replaced it with a spoof malicious transaction, and they got signed. So what should have really happened here? I think one thing that's quite important here is that we should always, all signers on, especially on high security wallets such as this, they should always verify the transactions on their hardware wallet are what they intend to sign, and they should use a third channel to be able to do that rather than trusting the user interface. And so it was really on Bybit to actually, the signers to actually verify that what they're signing on their hardware wallet was what they intended to happen. Now, technically, I know that that's very challenging to do, and I think as an industry, we need to improve the usability and user experience around this process, because I know from personal experience that it's very challenging to verify the actual details of what you're signing on your hardware wallet. But there are tools, and I think the industry is improving this type of stuff. So that's basically a high level of what went wrong and how the funds were lost. And I guess from a centralized exchange point of view, when you're a user of a centralized exchange, you're essentially trusting the centralized exchange to operate effectively and make sure you've got your funds, enough funds at all time. Now, Bybit was able to handle this loss by basically eating the loss themselves and effectively taking it out of their own profits. And so no users have been impacted as yet. Presumably they're still fine. They say they're fine, so that's good. So in order to I guess that kind of leads into one of the things we've been doing very recently. So earlier, late last week, we re-released custody cover, which actually provides coverage option against this type of thing. So it would custody cover would protect against centralized exchange hacks that result in withdrawals of funds being locked for users for 100 days or more. So if you can't get your money out for a long period of time, basically the exchange has gone under, either it's been hacked or something else has happened, like an FTX type scenario. It doesn't matter what it is. If the withdrawals are locked for 100 or more days for all users, then you can get a claim payout. And so this has been a very popular cover, and we definitely had a whole bunch of demand and people requesting this before we launched it. And then the recent Bybit hack has increased that interest quite a lot. So check it out. It's another very useful tool that you can, if you're trading across CeFi and DeFi, you can combine this with smart contract coverage for the DeFi positions, and use the custody cover for the centralized exchange position. So check that out if you haven't already. On the other things like protocol improvements, excuse me, we've been working on there's a whole bunch of different improvements going on. Two of the biggest ones right now are cover edits and limit orders. So we're in the final testing stages of both of these, and they'll head to audit in a few weeks' time. Cover edits basically allows you to edit a cover when it's partway through. So for example, if you bought a cover for 3 months and it's 2 months in, and you want to change the position or increase it, then you will be able to do that, or extend the cover, so easily renew the cover before it expires. So yeah, we've been working on this one for a while, so it's great to see it kind of finally coming together and get released soon. Limit orders is another interesting one, and one of the cool things you can do in DeFi. So one of the idea here is, say you see a price for a particular product, or there's not enough capacity and all the prices are a bit high and you're only willing to pay a bit less, you can put in a limit order and say, look, yeah, I want a few million of coverage on this for 1 percentage point less than what it's available on Nexus at the moment. And then you can leave that order open for, say, a day or a week or something like that. And then it gives the opportunity for the stakers who are the other side of the market to either accept that limit order or not. So they could fill that order for you, knowing that it's in the market. So it just means that the marketplace is more open, and it's kind of much more two-sided. The demand side can go, look, here, I'll place my order, and then I'll look to see if any supplier can fill it at the rate and size that I would like. So that's pretty cool as we move into a more marketplace for risk and stuff like that. So that's going to be released hopefully at the same time as the cover edits. So again, coming to audit in the next few weeks. Those are the main updates from my side. Though I will have a bit of a shout out on this call for a product we released a little while ago, DPEG cover. And one of the things I wanted to highlight here is that the more and more, we've had some really strong cover buys over the last little while, especially on like Maker, Savings Rate, the SUSDS, and like Level USD, and of multi-million size here. So quite substantial. But one of the things I really like about this is it shows the way that DeFi's elegance can really provide some really cool tools. So DPEG cover works by allowing you to swap a token. So say you've got a position in DeFi, you get a token back, and that LP token represents your position in a particular protocol. What DPEG cover allows you to do is allows you to effectively swap that LP position back to a stablecoin, USDC, at any point, or if it's an ETH-based position, you can swap it back to ETH. And so what this allows you to do, it doesn't matter what the risks are, they're all kind of reflected in the DPEG. And so it's a very simple product solution that you can do in DeFi that's very difficult in TradFi, but it allows you to cover all manner of risks. And as Brave was mentioning before, when you've got something like Athena, which is essentially running a tokenized hedge fund across multiple different DeFi protocols, as well as centralized exchanges. So they're taking on all manner of risks, admin controls, legal risks, smart contract risk, a whole bunch. Here we can provide one DPEG swap product which encaptures all of that risk in one simple, elegant kind of solution. So there's some really cool stuff that DeFi can do that's a bit more challenging in TradFi. So do check that out if you're looking to get more into DeFi and as you explore the yield opportunities that Brave was mentioning. So yeah, that's it for me from this week. Happy to take questions if anyone has them. I'll hand back over to you, Sam.
Thanks, you. We will also have a dedicated Q&A section after my bit. So please feel free to post your questions then as well. Before diving into the other community updates, let's take a moment to review last month's sales. Despite market uncertainty and red candles, our members continued to earn and deliver. In February, Nexus Mutual sold over $135 million in cover, with members generating more than $639,000 in premiums. Looking at the bigger picture, members earned more in premiums in January and February than in all of 2023 combined. February also marked our highest number of covers sold since launching Nexus Mutual V2 in the March of that year. This is almost 2 years ago. A strong start to the year. It's a good reminder to keep on building. Now on to the DeFi and Risk Learning Group. This is an exciting opportunity designed for DeFi enthusiasts and risk professionals looking to build a solid foundation in decentralized finance while exploring key risk factors and protection strategies. Our sessions will cover everything from DeFi basics to smart contract risks, governance attacks, and how to mitigate them using Nexus Mutual enabled products. The first cohort kicks off in early April, and it will run through June, featuring monthly live sessions, bi-weekly digests, and guest speakers from top DeFi projects. All sessions will be public and available on YouTube, but to encourage hands-on learning, the participants at the cohort will be able to utilize a small budget to experiment with DeFi protocols, helping participants explore concepts in real time. So, if you're looking to deepen your knowledge and engage with a community of like-minded individuals, please apply before the end of this month. Priority will be given to those with risk-related backgrounds, but we're hoping to create a diverse cohort at this first one, and will hopefully create a nice peer-to-peer learning opportunity for all of us. That's it for now. Looking forward to seeing many of you in the first session. Now let's kick off the Q&A section of this call. This is the first time that we are restreaming through our 3 different social channels. I am testing the tool as well, so please bear with us if there are any lags or delays. But please do post your questions on our YouTube, X, or the LinkedIn event. If you don't have anything to ask us at the moment, we will also provide you with the platform links that you can find us anytime. As we wait for any questions to drop, I want to perhaps open the stage with a brief question to Brave. Brave, how did you get into DeFi? I'm sure many people must be wondering.
I got introduced to Bitcoin in early 2020 by a friend, and I started looking into that, and then I discovered Ethereum, and then I learned about DeFi, and I thought the idea of DeFi and open transparency in finance was very interesting, and overall I thought that blockchains would allow for greater efficiency and reduce overhead costs. And I think that thesis of why I got in held out to be true. I mean, looking at what we do at Nexus, I think there's 18 people working at Nexus. We originate a large amount of cover sales. Most of what we do is automated. And whenever I meet with people, they always think there's a lot more people working at Nexus than there is. I think looking at other things in the ecosystem too, like looking at Tether's earnings versus looking at Goldman Sachs earnings, it's pretty clear that there's massive overhead that you can cut when you're using blockchain tech. But when I got in, I really just became obsessed with DeFi and just started researching, and I went down the rabbit hole, learned about all the major protocols and everything, and it very much clicked with me. And I came across Nexus Mutual when I was listening to or watching a DeFi Dad video about Nexus. And it seemed like something that was very underrepresented in the industry at large. And then I just started getting involved in the DAO and started contributing, and got involved in 2021. And from then on, I started working full time for the Mutual. And I've been very, very active in DeFi ever since. I'm constantly looking at risk on chain, constantly researching new protocols. There's a lot of interesting things happening in the space. Risk is 24/7, especially with large market movements like we've seen. you're always wondering if things are going to break. I think DeFi has gotten a lot more resilient from when I first got in 2020 to where it is now, where when we have flash crashes or major drops, things don't break across the board. So yeah, that's the long and short answer of how I got into DeFi. It's still very entertaining and it still keeps me very busy, but I still very much enjoy, watching on-chain markets and looking into risk every day.
Before we wrap up this section, I also want to ask a question to Hugh. Hugh, how do you think Nexus Mutual will evolve in the next 2 years or maybe 3, which is a long time for DeFi, we must accept?
Yeah, no, good question. I think right now we're primarily focused on like crypto native risks, and that's where we found our solid niche. That's basically a very underserved market from an insurance perspective, and so a community-based solution makes a whole lot of sense, especially when that community really is a lot closer to the risk and understands it a lot better because it's involved in it day to day. And I think that principle can be applied much more widely, and that's kind of where I hope to see Nexus Mutual grow. And I think I basically expand into different markets, whether that's crypto or not crypto. We currently have a little bit of that going on. Like we're covering some retail shop owners in the UK from just normal flood, fire, theft, that type of stuff. So basically looking to attract different people, different experts like underwriters and people who can price things and distribute products and utilize them to build on the Nexus platform. And kind of I see Nexus as a platform of connecting capital to underwriters, and the underwriters build the products and then distribute them. So I think more kind of trending in that direction as a platform for others to build on rather than a full stack crypto the coverage provider. So that's kind of the morphing that I see going on over the next couple of years, but still very much crypto for now. There's a lot of risk to cover within crypto, but I think it's also getting much more robust and much more ready for kind of prime time, and I guess more kind of institutional traditional money. I think it's ready now, and so hoping to see that happen over the coming years.
Thank you. Very exciting times ahead, hopefully, for all of us. All right. If we have no more questions, we're ready to wrap up this call. Thanks, everybody, for joining us. If you have any questions anytime, please hop onto our Discord. We are there most of the time, and we look forward to seeing you at our next DeFi Pulse. Stay safe in DeFi and take care. Bye.
Thanks, everyone. Bye.
Bye, everybody.